to really understand the business model. What does the company actually do? What are its products, its services? What makes it unique?
Like your McDonald's example, it's not just burgers, it's a franchise and real estate powerhouse.
Exactly. Understanding that deeper business model is crucial.
Which leads to the moat idea, competitive advantage.
Probably the most important qualitative factor. What gives this company an edge? What protects it from competitors nibbling away at its profits?
Could be patents, scale, regulations.
High switching costs? Like trying to ditch Microsoft Office across a huge company. Network effects where more users make it better, like Visa or Facebook. Buffett loves businesses where there's an absence of change because stability protects profits. A strong moat lets you raise prices or fend off rivals. It's the castle wall.
And the people running the castle. Management quality and shareholder friendliness.
You have to ask, do I trust these people with my money? Assess their integrity, competence, and especially how they allocate capital.
Yeah.
Are they building value or lining their own pockets?
Red flags being misleading investors, crazy high pay, burning through cash.
All of the above. Serious value investors dig deep here. Randall Abramson meets management quarterly, asking the same questions, looking for consistency, passion. Candace Weir builds personal connections for insight. Edward Studzinski used his criminal defense background to spot when management might be less than truthful.
Wow. You're looking for honest, capable stewards of your investment.
That's the goal.
Okay, we've got the tools. Now, where do we go hunting? Where are the strategic spots to find these potential deals? You mentioned the bad news phenomenon.
Yes, the market often overreacts, right, emotionally. Bad news hits, earnings miss, lawsuit, recession fears, and prices can plummet way more than the fundamentals justify.
Creating opportunity for the rational investor.
Exactly. Buffett saw this in the '87 crash.
Yeah.
Panic everywhere. But he saw quality companies being given away, some below book value, even though the U.S. economy was still fundamentally okay. He saw bargains where others saw a disaster.
Like Christopher Brown said, buy stocks like groceries when they're on sale.
Perfect analogy. Fear drives prices down, creating those opportunities. Takes courage to buy then, but that's often where the best returns are made.
Another hunting ground. Spin-offs and reorganizations. What's the opportunity there?
So a spin-off is when a big company sets a division free as its own independent, publicly traded company.
Okay.
The opportunity arises because big institutions that own the parent company might be forced to sell the shares of the smaller, newly spun-off entity. Maybe it's too small for their mandate, wrong industry, whatever.
So it's not selling based on fundamentals, it's forced selling.
Precisely. That can artificially depress the price of what might be a perfectly good, newly focused business. The classic example is eBay spinning off PayPal.
Which worked out pretty well for PayPal shareholders.
Extremely well. Suddenly, PayPal was free to focus, innovate,